Welcome back on the channel, my friends. Let's yield farm Solana. I will show you how you can set up a liquidity pool or plenty of liquidity pool positions using Solana for passive income. Now, as a complete beginner, you want to go on Orca. Make sure you are on orca.so. So this is the real website. You're not getting fished for something else. Never go on Google and try to search for DeFi protocols, okay? Because the search results can be manipulated and they can be showing you some other website that looks like Orca, but it isn't. So make sure you are on orca.so. Then you come here on pools and you input, I already did this, but you input Sol, then you will input USDC, it will show you USDC. This is the most traded pair on the Solana ecosystem, on the Solana blockchain. And even if it's not the number one every single day, it's going to be at the very least top 5. But if we average it out for the whole span of a year, this is the most traded pair. I go in more depth about that in older videos, but in this one I'll keep everything much more condensed, just so that you understand the basics, you know? So the price is at around $80, $77, and we see that we bottomed here at around $60, and the price has been recovering. Now, if you want to yield farm for passive income, essentially it goes down like this. If you go with the tight range, this is the overall 4% range showing here, 2 on the downside and 2 on the upside, you'll yield more than a wider range. You get a higher yield, but likely you will go out of range faster or easier, because that's part of the risk when depositing into concentrated liquidity pools. If you see here in this range, the price is not always in that range. It has been recently moving along this range. For example, you can see here these spans of time in between the 7th of July up until the 16th. Pretty much Solana chopped sideways in this price range. It went out of range on the downside here, but whenever it goes out of range, don't follow the price. If you keep following the price and just readjusting your position constantly, it will do you more harm than good, let me tell you. You take a breather, and in this case, you would have only to wait in between one day. Roughly one day. This went out of range at around 8 o'clock of July the 30th, and then at around 12 o'clock of July the 40th, it was back in range. So you see, it didn't take all that much longer than a day to just go back into range. Here it was a bit different. Did went out of range on July the 16th, and now on the 19th, it went back into range. But you get the idea. The tighter your range is, the easier it is to get out of range. So you gotta play with that, right? So depending on how much you have available, even if you only have a couple $100, but you wanna give it a go, right now it's a good point in time to start because the price is at a lower point than it was at the beginning of the year, where Solana was trading at around $100. If you bought back here and you were just testing things out, you then would have to handle this price drop, which was substantial, and most people don't have the mental fortitude to just undergo this drop in prices because they don't really know what crypto is all about. They're not used to this. Crypto is very unique when it comes to volatility. So if you're a complete beginner, it's very important that you only deposit what you can afford to lose. I'm not saying you're going to lose money. Likely you will lose it if you make bad calls because Solana is a blue chip. And you can apply this for any number of blue chips, Bitcoin, Ethereum. Now, since we're talking about a very tight range, this is the estimated yield for 24 hours. This is going to always be a projection. You can get more or even less than what's showing here. It's going to depend. Right now, the markets are not all that hot, I can tell you. My liquidity pools are not yielding as much as before, but that's also the name of the game on yield farming. Sometimes you'll earn more, sometimes you will yield less. It pretty much depends. In any case, what you can do, you can set up multiple positions for the same liquidity pool. You can have a smaller allocation of your portfolio into a range like this or a 5-5 range. So you see something like this would still yield you almost 0.2%, which is very decent, I would say. If we translate this for a whole week, you would get 1.3% a week. So that's really good. Now, let me put this back to 24 hours. I did mention on a previous video the 80-20 rule, the Pareto principle. I like to use that as a rule of thumb. So in that case, if I would start yield farming this liquidity pool, I would deposit 20% of my portfolio, 20% of the value I can invest into this range, which is a tighter range. Yes, it's only 20% of my capital, but it will yield me more. And then I would have a wider position that could be something like this. I'm just going to look at the chart. I'm not going to backtest all that much, but I'm just going to simply lower my downside to this recent bottom at around $60. And then on the upside, I'm just going to protect myself a little bit for a potential appreciation. So let's say I want to go up to 85, something like this, And in this range, I would deploy 80% of my capital. So you see the estimated yield here is much lower because we just spread our liquidity position through a wider range. So it's going to yield us less. But then again, don't get too caught up in this. Either if it's really high or really low, these will change over time, okay? Now, this would be an example of a more conservative position, but what you could do, and that's personally what I do because that's just my style, I'm more optimistic, so I tend to have some more exposure on the upside. We currently have at around 10% exposure on the upside, so that means from the current price up until our upside range. When the price crosses our upside and downside, we stop earning yield. We don't lose money, our capital is still there, we just stop earning fees. So let's say I want to have both the upside and the downside at around the same percentage. So let's say I'm just going to go here and insert 20%. So something like this. This is already looking good. If we are back testing, and we are, just looking at the chart, we can see that this range potentially would have earned us yield if we had set it in place back in February when we had this first initial major dip. So what we saw from here on, since February the 5th, the 6th, around that time, Solana started chopping sideways. Had we opened this position back then, we would have spent the next 1, 2, 3, 4, 5, 6 months in range generating us yield. We wouldn't have to touch a thing. And this is how DeFi passive income works, guys. But you have to think for yourself and make your own decisions and think, okay, do I think Solana is really going to go up to $90? I personally think it will. Probably not in the short term. But it doesn't really matter. As long as we are in range, we can compound the yield back in, we can deposit more, we can take the fees as profit. But the essential takeaway is this: spread your liquidity in the same liquidity pool into different positions. Have a wider one and then have a tighter one. And this is just one strategy. We can keep doing this in different ways. We can have, for example, a starting liquidity layer. I'm going to call it layer, but a starting liquidity position like this, where we deploy, let's say you can invest $1,000 each month on Solana and you want to do so. You can start with this position, deploy $1,000 here, and then on the first day of the next month, you would reevaluate. You can deploy a whole different range. Now, this range in general is 40%. Remember, 20 on the upside, 20 on the downside of the current price. So next month, you could deploy $1,000 more, but you want to be protected on the downside. So you would remember this 40% and do something like this. You would lower here to 10%. You see now it's 9.5. You can also come here on the right side, insert a max price manually or minimum price manually, or just play around with this like so. But since we lowered 10% on the upside, we can also lower it 10% on the downside. So something like this. But now we have $2,000 in deposits in different positions earning us yield. This would be more conservative, again, because we are more protected on the downside, but you can also apply this on the upside. And as time goes by and you deploy liquidity around the current price range, you will have some winning positions. And by winning, I mean where you just swapped your Solana for USDT, so you are closer from your upside, you're at the profit, and you'll have some losing positions. And by losing, I mean where you are accumulating Solana, your position lost fiat value, but what you actually did is that you accumulated Solana. Now, before wrapping up, guys, I don't know if the market is going to go up or down. Never try to time the market. But what I do know is, if I'm betting on a blue chip, I'd rather buy it at $70 than at 100 or above. And that goes for everything. But if I keep being consistent and deploying capital into this liquidity pool because I'm bullish on Solana, eventually my capital grows over time. And once the tides turn and Solana starts going up to $100 per token, all of the positions we kept opening in the past months, they will be sold for USDC and we are at a profit in all of them. In the meanwhile, we earned passive income. Now this is a very simple, straight to the point video, guys. I can do a step-by-step tutorial from buying crypto from your bank account. I'm probably going to do videos about it, but if you want to see that sooner rather than later, let me know in the comments and I'll speed up the video. That being said, guys, hope you took value from this one. I will link up right now on screen some of the videos where I go deeper about this 80-20 rule, the Pareto principle applied to liquidity pools. That being said, guys, thank you for watching. Take care, keep exploring crypto, and I'll see you in the next one.